buy right asset, maybe the proportion is not that high among your proportion. So how to
The reading that gets you going is they
you know what? For example, among your assets, maybe there's some good asset, proportion is not that huge amount. All of it, you will have some exciting assets, but maybe they lost some money or huge amount of money. And even maybe you're being scammed like life. So, you know, this, of course, it's
I tend to save the things lower risk. Yeah, kind of under the radar investment. Kind of safer, but slower, very slow, right?
yeah, slower. That's maybe, how to say, convincing or guaranteed.
But every stock can get cheap. Like you have Meta. That was very cheap, like a year ago, right? And they do amazing stuff. It was just undervalued by the market. So occasionally there's opportunities.
Actually, normally, a lot of people have the wrong behavior. Even me and you maybe have ever experienced this. Once the market is very noisy, you have a FOMO,
Oh yeah.
FOMO feeling.
It's just
And everything is expensive, and then still you put some money in.
just human psychology.
Yeah, it's a problem. We have to, overcome this.
唔係，你有冇中咗獎？
Yeah, you have to be aware of what.
例如嗰個，又例
If
如
very opposite, for example, in case you must face difficulty,
我啱你做阿 Sandy 啊，話佢15分鐘，所以咧佢乜都攞咗就話比較有遮，但係其實咧就
many years ago,
係咯，不過我都做唔到，
and very good timing like a 400 price, and then you will, I don't know why you jump into the market, and then you went somewhere really hard. Some friends is
Yeah, I have a lot.
half year salary. You lost half year salary. Why don't you have a half year holiday and then take a rest and then you lost half year salary.
I have many friends who are bad investors.
400 something. You lost half. This is amount like in case you calculate is nearly your half year salary.
唔係我如果佢係準時4點幾咧，係啊，就係咁解。
Much important than just looking at the chart, blah 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 blah. It is always easy to confuse. So this I think still I would say studying is very very important. Yeah.
呢個我之前讀過，但係
So investment
好似叫幾多錢咁呢個但
and
係
also
我
is
知道
first of all make yourself stronger in
It takes years to develop. But I think people should give up. They should learn
講
from
時
mistakes.
就應該係我上次遲咗就話俾佢哋食。
Yeah, try it. You got it.
係啦，試咗一次，咁跟住到
Everybody make mistakes, but the issue is how
點
to
今次
cover
個到嚟佢又
mistakes.
So the risk management is very good.
Yeah, yeah. Everybody so it is old statement like I don't put
我冇，係啊，因為唔係啊，佢7號嘅啫，但係我咧就我7號
It is hard though because at the
咁佢
same
而家
time
就係咩過咗隻
you
啦。
can't be too I think you shouldn't be too diversified, like 50, 100 stocks. Too much, right? If you want to have good gains, 20, maybe 10, maybe 5. But then more risk. So
合伙上你有冇？
stock is the easiest to cash
即係以前喺黃竹，即係喺海湖公園嗰個嘛，一上次去台灣酒店。
For example, 2 years before everybody in Hong Kong is have religion on property.
oh yeah.
No matter how high, 7 million, 8 million,
I
still
was
jump into the market.
I was against property because there's so many new property building. I just thought supply and demand.
Yeah, they're just drumming about it. So
And it's just very expensive.
right now, a lot of people working at subway cars, property stock is 2 to 3 million.
係啦，呢咁新嘅即係發嗰啲人有收
Yeah, and also your mortgage amount increase because of rental increase. And sometimes your life is difficult. Yeah, sure.
哦，我以為佢粒心開 同埋我有時睇 YouTube 睇到佢介紹嗰部機嗰啲。
啲 herein 嚟㗎。
哦，不過佢都應該係差啲，因為我見到佢嗰度寫住嗰啲咩叫嗰個部飛個價錢都係平啲，低啲，咁就應該係低啲咯。
咁 suppose 佢可唔可以你哋啦？Friends together.
My girlfriend's coming. She'll be.
可以，how about you? I'll try to tell him.
I'll check out.
3次咋？少見，因為兩次你揀咗第一次，之後第二次撞6敗，好似冇拍到。
Hello everyone, we still have a few minutes to go. Before we start, you can scan the QR code on the screens to answer the questions, and the result will be shown in the end of our event. I don't speak the agenda. Good evening, ladies and gentlemen. Welcome to tonight's event, Investing in the Age of Uncertainty. My name is Winifred. I'm your host today and keep you company. We've got an exciting program lined up for you tonight. You will hear from an amazing group of speakers. We have Mr. Kevin Lee and Archie Parak from Syfe, Mr. Thomas Toff from BlackRock, Ms. Jing Jing from PIMCO, and Mr. Dennis Fogg from Viray Asset. They will share their views on tackling the volatility in today's market and tips to optimize your investment. And we'll wrap up with a Q&A panel discussion, and our team will hang around afterward for some personal questions. We also have some coffee, tea, and wine, along with some delicious refreshments to enjoy later. So please sit back, relax, and let's get started. Let's welcome our first speaker, Mr. Kevin Lee, General Manager at Syfe Hong Kong, and Mr. Archie Parak, Group Head of Risk and Head of Investment at Syfe Hong Kong, to give us an introduction of Syfe. Let's welcome Kevin.
Thank you, Winifred. So, welcome everyone. Thank you for coming. Thank you for joining us tonight. As usual, I will ask how many of you before coming to this event or hearing about this event already know Syfe? I heard of Syfe. Good. Very nice. Very nice. So I think to kick off, right, good to give a brief background of who we are, right? Who is Syfe, right? Syfe is actually one of the Asia's largest digital investment platforms, right? Digital first. We have a mobile app, right? We help people invest. And we aim to help everyone build their wealth for a better future, right? And there's a slogan, right? And you see the photo, right? We want to make your cash work for you so that you can sit back and relax like this family here, right? And let the cash grow by themselves, right? So that's our vision. We focus on long-term investment, right? And we provide cash management solution, managed portfolio, and also brokerage. We are all in one digital platform. So looking at this, right, this is our main app, and across Asia, we already have 250K users, and we are recognized by a lot of platforms as one of the best wealth tech in the region. We are founded in Singapore in 2019, authorized and regulated by the MAS, and in Hong Kong, we got the SFC license in 2022, and we started a year plus of what we call a pilot phase. With official launch in 2023, we're experiencing rapid growth. And one thing we see in Hong Kong is, I think you guys, a lot of you really love cash and income, right? Recent years is gaining a lot of traction in the region, right? And we also have business in Australia. We expand in Australia, right? The 3 major wealth hubs of APAC, and we also got license there, and we are rapidly expanding there as well. So who we are? Our founders from UBS. We are a group of professionals from many different leading organizations, not limited to financial services firm, right? Like our founder from UBS or our investment head from UBS, right? Myself, I was the former APAC digital business head from Shoulders Investment, and I manage across 10 markets, different digital businesses development. And we also have our CMO from Lazada, right? And P&G. So it's a mix of a lot of talents that build this company together. And today I just want to briefly show you what we do here in 3 pillars, right? And in Hong Kong, we have launched 2, right? As I mentioned, cash, right? Maximizing and optimizing your idle cash for up to 4.2 or plus, PA, And we have 2 products, one flexible, one with fixed rate. And we have the managed portfolio, and income is so loved by the Hong Kong people, right? We can offer an income portfolio with up to 60% cost saving, right? And we'll go into that in a bit more. Our investment will share more. And we also have a lot of long-term wealth building managed portfolio. And something very unique about us is there's no minimum, no maximum, very short or no lockups. It sounds like, oh wow, it's too good to be true. But that's real. And that's how we have grown rapidly managing multi-billion dollars in APAC, right, in Singapore, right? For brokerage, we also take a different view. I think a lot of you would use banking app for trades. You would use like Futu, right? For brokerage, we have very unique solutions like side bundles. We have AI-powered guide. We build automated investment plans. It's more long-term. It's a different proposition, right? And we'll launch in Hong Kong, right? It's currently already available in Singapore and Australia. So why people trust us with investment? And like event like this, we run a lot, right? And previously we had another event on retirement with the largest MPF provider, Manulife. And today we have BlackRock, PIMCO, and Global X, right? We are regulated with Type 149, right? We also have MPFA Principal Intermediate License, so we can give you retirement advice on your MPF account as well. We have custodian partner, HSBC, Interactive Brokers. So money is safe with them, right, as a custodian partner. We have trusted partner, as I mentioned. And in Singapore, for example, when we launch a product, REIT Plus, right, we launch it with Singapore Exchange, right? We drive a lot of strategic partnership across APAC. And all our product launch featured by a lot of the tier one media. And one more important thing, like a very good news, like in Q3 last year that we have announced, is at the group level, we have achieved profitability in 4 to 5 years. And it's very important because we're talking about long-term saving. You need a firm, you need a company that you can, put your money with a peace of mind, right? And grow the long-term wealth. And that's why we grow rapidly, but we grow with efficiency. And there's a big news for us, and we also attain new capital, Series C, right? So good to have all of you here. I want to also invite Ajit, right, to share the market with you.
Hello, welcome everyone. So I think before we invite our guest speakers, I just wanted to kind of unpack where we are in current markets. I think that'll help all of us to give some context of what to look forward and how we can position things better. So I think S&P 500, I guess everybody would know, probably the large cap US index has fallen 10% from its peak and has gone to a similar level which we all saw before the elections. In typical financial markets, like what's called a correction is when index or stocks fall by 10%. So S&P has entered into that correction territory recently. Now, but if you look at everything else across the board, other than some of the local markets, China, gold, European markets, bonds have all done pretty well. So we see that S&P, which obviously has been kind of the golden star for last decade in terms of equity markets and performance, is in a negative territory recently. But I think the more important point here is it just reminds us of like the uncertainties that are ahead and the value of diversification, like all the other asset classes, and the importance of not just going into one single market sector, but keeping things a lot more diversified in our portfolios. Just going deeper into the US, and again, that importance, like tech names, which again have rallied in last couple of years, more than 40%, NASDAQ consistently for last 2 years, have started to give some of that back. Tesla was down close to 40% at some point. Again, if you see, while some of the other sectors have fared pretty well. So re-emphasizing the point that diversification versus concentration of risk and how to navigate, especially in certain market dynamics, is important. How to position your portfolios so that you're not panicking, you're not looking at things and taking behavioral decisions is super important. Now, I think like we want to see it in a picture where, like, okay, we call like basically 4 trends. 4 trends that so far in the year and potentially will define the rest of 2025. First one, I think all over, basically the biggest thing, which is about tariffs. Second one, I think which has been the major focus for last few years is the Federal Reserve action in the US around interest rates. And again, it'll largely depend on how US economy play around for the rest of the year, on how Federal Reserve will act, on how many cuts and how soon. China, I think closer to home, I think is finally giving confidence of the markets. We have seen quite decent rally this year. The question is how sustainable this is. Is it the time to enter? Is it the time to take profits? And obviously, nothing can be without talking about AI investments. We saw Alibaba, DeepSeek pulling in their weights recently, which again led to some of the tech sell-off in the US. I mean, this is a thought, a way, or a segue into things, how you can look at rest of the sessions today. These things are going to be the key levers that are going to impact 2025 in a significant way. I think before we move on, I just want to quickly give you a snapshot and just put a thought of, again, to extend what Kevin was saying, like who and what we offer. We'll come back to this in the later segment, but I think cash solutions in Hong Kong dollar, US dollar, income solutions in a diversified bond portfolios and some growth offerings. Just keep this in your mind while you listen to the other sessions, and we'll come back on how these portfolios can help you navigate the rest of 2025. Yeah, so I think for people who came in late, just a reminder, there is a poll, and you can even submit your Q&A by scanning the QR code here. So while we are all speaking, feel free to raise your questions there. So I'll invite Thomas Tor, the head of APAC Investment Strategy, BlackRock, to take it forward.
Okay, hi everyone. Nice to be back here. Thanks to Syfe for putting on this amazing event. I'm going to pick up on some of the themes that Archie talked about. I've only got 10 minutes, so I'll speak relatively quickly. But we have this monthly presentation, which we call Alpha Bites. And this month, we're basically talking about diversification. And essentially what we do is across our big investors, our pension funds, our sovereign wealth funds, we basically ask them, what are the big three questions you're trying to solve for this month? And actually, these questions haven't really changed from the last month, but I think these are the three key questions in the market at the current point. The first one is around the US correction. So how far do we think this is going to run? What is actually happening here? The second one is around China, and the third one is around Europe. And I'll talk a little bit about how these are all correlated. So when we look at recession, it's come up a little bit more over the last couple of weeks. Recession in the US, is that possible? At the moment, a recession in the US is currently being priced at around 25%, so it's still not a base case. To put this very, very simply, what has happened moving into 2025 is you have a situation where, number one, the market starts to price in Trump policies in the US and then calibrate that down into the rest of the world. In the US, the expectation was that, number one, the tariff situation, of which none of us really knew the exact numbers, but the tariff situation was essentially a negotiating ploy to get better deals for the US in terms of imports and exports. It's turning out that that might not actually be the case. And so when you look at asset allocation going into 2025, what you see is the majority of clients and the majority of brokers and the majority of asset managers are overweight US equities. And we hear this term, US exceptionalism. When you dig one level down, what you start to see is the expectations for earnings growth for US companies, and particularly the tech sector and the AI theme, are very, very high. What is starting to transpire is the fact is that the tariff situation is not particularly good for anyone, and it's inflationary. And when you look at Trump policies, the quote-unquote bad stuff is happening now, i.e. tariffs and i.e. deportation of labor. The quote-unquote good stuff, which was being priced in, talking about things like cutting of corporate tax rates, that's not going to happen until 2026. So it's not an end of U.S. exceptionalism. What we're seeing now is a recalibration of the earnings expectations of U.S. companies. And when that happens, what you start to see is investors who are already overweight U.S. equities, even if they are neutral U.S. equities, by which I mean the U.S. equity portion of the global portfolio is around 2/3 already. So you already have a very high exposure to U.S. equities. You already have a high exposure to tech, growth, etc. So when this happens, we start to get a little bit more late cycle. The expectations of U.S. growth comes down, not significantly, but they do come down a little bit. And you see earnings growth coming down a little bit. And now you start to see a rotation. So if you're a global portfolio manager, where do I rotate away from US? It's not that I don't like US, but where can I find better value? That's essentially in Europe and the US, Europe and China for two very different reasons. But the main reason which ties them together is fiscal policy. So US fiscal policy looks a little bit tighter. The expectation is for maybe 2 to 3 rate cuts this year. We don't think that's going to happen. Inflation comes back a little bit. Then you have China and Europe where you have these big fiscal policy boosts, and so you see a rotation into China and into Europe. I think this will continue. The interesting thing about China specifically, so I think Europe is very much a broad move, right? You see a little bit more of impact in places like Germany where the fiscal policy is really coming. But in China, it's been a pretty narrow rally, right? So it's been tech, it's been consumer discretionary, the AI themes. We actually haven't really seen that much interest in onshore China. And the next question becomes, do we start to see that move into onshore Chinese equities that we have not seen yet? That question gets answered a little bit later in the year when we start to see whether Chinese domestic consumption picks up, because consumption in China has been poor for quite some time. And then does that feed down into earnings, right? So earnings, traditionally for most countries comes through once a quarter. Will earnings start to pick up in China, and then do we start to see a rotation into Chinese onshore equities? So for us, in terms of the implementation, it's not really about selling U.S. equities. We don't like to time the market. It's not really about taking down exposure to U.S. equities, but we do think there are certain plays that you can make within U.S. to actually mitigate your volatility. So, for example, equal weighted index, that's performed much better than S&P 500 this year. Why? S&P 500 is market cap weighted, so you have a lot more weight towards these big companies that have been performing very, very well over the last 2 years, but even the last 10 years. We see a rotation into some of the smaller companies, smaller cap companies in other sectors. Equity factor rotation strategies has been a big one for us as well. That's kind of a fancy way of saying we're seeing a rotation from growth into value, i.e. portfolio managers are looking for cheaper type of exposures. And financials as well has been another one that has outperformed, because we actually think the financial rotation is a real rotation. I think I said this last time I was here, but the rotation into small and mid-cap stocks, which happened post-Trump, didn't actually look real, because what we saw was a reaching for higher beta type of exposure, which is a fancy way of saying taking on more risk. But the smaller and the mid-cap companies struggle when interest rates go up or don't go down as much as expected. So financials looks real because we see deregulation, increase of mergers, acquisition, etc. Outside of the US, China still looks quite interesting. We're still waiting to see whether we start to see a pickup in consumption. But certainly in the tech industry, that looks very interesting. And then how do you mitigate downside risk? So gold is a momentum trade at the moment. It is above $3,000 per ounce. However, gold is not a great hedge for recessionary type of environment, because generally when you have a recession in the US dollar goes up and gold is priced in US dollars. But it is a very good hedge for geopolitical tensions. So gold we still like. Buffer type of strategies, absolute return equities. This is basically saying we like strategies which are diversified, which have market neutral type of approach. And then finally, in terms of inflation, Gold, again, features here, but certainly inflation-linked bonds and these kind of exposures will help mitigate the portfolio. So if you look across these four things, it's all about diversification, and it's all about mitigating this downside risk. You can do that in equities. You can do that through income. There are a lot of exposures that you can use. Very, very quickly, in terms of what clients are actually doing, you can see here in terms of this rotation, we're starting to see a little bit into Europe, particularly over the last couple of months, as denoted in the yellow here. This is relatively new, but this does tend to happen when we start to see downside risks to the US economy. Investors shift into value. If you look at what's actually in Europe, it is a lot more value sensitive. It is a lot more, the sectors that are in there are much more correlated to value. So you see this rotation into Europe. That doesn't always last very long, but you do have a fiscal impulse coming through in Europe, so it still looks quite interesting. And you can see the same thing here when we look at the flows into Europe. Japan, we still like over the medium term. I will say this in a very simplistic way, but we like China short term, we like Japan medium term, 3 to 5 years, and India will continue to be the structural growth driver of Asia, but we still have a little bit of concerns over valuations and also the underlying market being driven by retail investors. So I think there's still a little bit more of churn to come out of India. And then finally, when we look at, as you can see here, China versus India, the rally that we saw in September when the People's Bank of China came out with fiscal policy that was not being expected, that was very much a beta rally into onshore China equities. The current rally is very, very different. This is being driven more by tech and the underlying momentum that we're seeing there. And if you look actually over the last couple of months, we've actually been seeing some outflows from China. And I think the basic summary here is that the foreign investors are still very much underweight China. That's been the case for a number of years now. We do expect outside of US pension funds, we will see some inflows back into China at some point. But again, in Asia, it's about short-term China. We don't know exactly what's going to happen. I don't think anyone knows exactly what's going to happen, but there is momentum there. The underweights are quite prevalent, and the valuations look relatively good. So for a tactical trade, we still like China, and we wait to add India probably in the second half of the year. So that's it from me. Thanks very much, and I'll pass it back to...
Thank you, Thomas, for your valuable insights. Yes, it's our honor to welcome Ms. Jin Jin, Senior Vice President and Product Strategist at PIMCO, to share her insights in the fixed income market. Let's welcome Jin Jin.
Thank you and good evening, everyone. I just want to start my presentation by introducing who we are. So PIMCO is the largest active bond manager in the world. So today, the outlook that I'm going to share with you is a collection of the wisdom of all of our investment professionals and also the conclusion of our forum discussion. So the forum is a thing that we do every quarter, and we gather all of our investors within PIMCO, and also is advised by our Global Advisory Board, which was chaired by Dr. Ben Bernanke. And if you saw the news earlier today, the new chair of our advisory board will be Ms. Janet Yellen. So as you can see, the tagline today from our latest economic forum is "Uncertainty is certain," which is quite self-explanatory. And we wanted to remind everyone of the investors of the upcoming uncertainties in the world. And this is the index that we track. So this is the Trade Policy Uncertainty Index. It basically indicates how much of uncertainties we are seeing in different years. And you would see before this year, there was a few like small peaks during the years of 2018, 2019, and we reached another big peak this year. What do they have in common? DT in the house, Donald Trump. And so we wanted to look into all these uncertainties, and especially in the world of Trump 2.0, what does that mean to the government policies, to the global macroeconomics, and also to the Fed. So back to this page. This is a few of the key themes that we wanted to track and we wanted to focus on when we are talking about investment in the coming year. So first of all, we think that the volatility will become the norm. We're going to see a more volatile world. And we're also going to see a weakened consumer confidence, also with the market sentiment, and the US exceptionalism that we have been seeing for the past 2 years, which was powered by the stimulation from the COVID government fiscal spending, that is going to go away. And we're also going to see different central banks going into different parts of the cycle. We know that a lot of the central banks are already starting the cutting cycle, but we're also seeing different paces of that rate cut. So some of the economies are going to cut faster, some of the economies are going to be slower. So when we do that, we wanted to remind everyone that there will be relative value when that happens. So you want to stay global and take advantage of those relative values that's presented by the central banks. So what does that mean to our investment? So first of all, back to the trade policy uncertainty. So people think of tariff. A lot of times they directly link it to increased inflation. But another part of the story is the growth of the economy is going to slow down as well. And the longer term, that will actually slow down the inflation as well. So you want to focus on the net effect of the trade policies and the tariffs. And that's also how Fed will look into this. They are going to remove the one-off effects or the short-term shocks of the inflation and focus more on the longer-term inflation and also the shocks to the economy, GDP growth. So we think that going forward, the GDP growth for the US economy is going to be slower. We expect to see about 1% of the decline compared to last year. And for inflation, we think that there will be a risk or a pressure of the higher inflation risk. And we think that by the end of this year, you're going to see inflation moving sideways with more pressure of moving upwards. And for Fed, what does that mean? So as I mentioned, the Fed would want to look longer term, and also it would want to avoid or at least try its best to avoid a recessionary environment. And the previous speaker has mentioned the risk of recession is currently priced into the market for about 25%. And in our view, at PIMCO, we actually think that there can be a higher probability. The last time, as the latest forum, we actually think it might be 30 to 35% of a recession. So what does that mean? So if it happens, the Fed will need to cut faster or cut more to support the economy. Although, again, that's not our base case for now. And our base case is for Fed to continue the rate cut cycle with expectation of 50 basis points by end of this year, which means 2 cuts. But that also means the cuts will be more backloaded because we're still waiting to see how the labor market and how the inflation and also how the economy will react to that. So what does that mean to investors? First of all, we think that it's actually a better environment for bonds. If you remember 2 years ago or a year ago, you probably have heard this slogan of bonds are back. A lot of the banks are talking about it. And this year, we're actually saying bonds are better. We do think that bonds are in a better position because right now, if you look at the level of the yields, it's still very elevated. And compared to pre-COVID, also compared to the past 10 years of average, you're seeing a much higher yield than before. And that means your entry point and your downside buffer is also much higher than before. So what does a higher yield means to investors? We did this historical analysis, and at PIMCO we love doing a lot of the data analysis, and we wanted to show you the conclusion. Historically, the starting yield has 94% of correlation with your forward 5 years of return. And these are purely based on historical numbers. And that explains why investors are taking advantage of this window of high yield environment to come into the bonds market. We have seen that from institutional investors, pensions, insurance. We have also seen that in the wealth management clients who used to park their money in the cash or just fixed deposits products, whereas over the past months and year, we have seen a big trend of people moving into the fixed income market because they are trying to lock in this attractive, elevated all-in yield. And some of them, we call them all-in yield buyers. And what that also means to investors is that with the high all-in yield that's provided by the market, you don't have to take too much of the risk to generate a pretty good yield. So here you would see on the yield basis, you can easily get close to 5% just from a market index. And 2-3 years ago, if you want to do that, you will have to go into the high yield market. Whereas right now, don't need to go down the credit curve, and you can already secure a pretty attractive level of the yield. So that explains why at the beginning of this presentation, we have the first conclusion. It's important to focus on high quality bonds, especially thinking about the upcoming volatilities that's going to present in the market. And another thing we wanted to share is the relative value that I mentioned earlier. So with the yield at elevated levels, it doesn't mean that you need to own everything in the bond market. There are still differentiations in the market that we wanted to find out. So there are a few things we want to focus on. First one is staying global. So I have briefly mentioned at the beginning how different central banks are cutting rates at different paces. And some of the central banks, we think that they have more room to cut and there's more certainty of rate cut. So when you're thinking about allocating your duration position, you probably want to be more diversified. And that's what we focus a lot on when in our portfolios, we want to look for the relative value. So right now we think that the duration in UK and Canada can give us that potential upside more than some other parts of the market. Whereas in the US, we still think there are merits to owning the US duration, but the market is also very volatile, so you want to be very dynamic in managing that position in the US. Let me go back to this chart again. So apart from the credit market that you see at the bottom, the green color, investment grade credit, overall their yield is still very attractive, but the credit spread is currently at a relatively tight level. It's actually tighter than 90% of the time in history. But we think that the tight credit spread level is supported by the technicals because people are continuing buying these IG bonds for the all-in yield and also some sticky demand from the insurance companies. So for investors, you also want to look for relative values or additional yield pickup from some other parts of the market that's less rich. So Securities is one of the examples. Agency MBS and AAA rated Securities is a market that we have been finding a lot of attractive alpha and yield in the market. So these are high quality for agency MBS. These are supported by the government agencies. So you're actually not taking credit risk, but you're getting wider spreads than the generic credit. You're also getting very similar level and sometimes higher level of the all-in yield in this market. So this is another theme that we are looking for. So look for relative values in different segments of the market. And last but not least, for the investment implication, I think we already covered high yield bonds, why it makes sense, and why it makes sense to stay global, and what are the relative value opportunities that we're looking for. And the fourth theme we have seen in today's market is to focus on the asset-backed financing. So compared to the relatively rich valued corporate credits, we're also seeing the asset-backed finance world providing us this support or protection from the downside and giving you additional yield from the market. So these tend to be in a combination of a consumer, residential, and non-consumer, and these are all the assets that's backed by the bonds or the opportunities that's backed by the assets. So one of the examples that we have in the public credit world would be the airlines and aircraft leasers that would lease out their aircrafts and generate stable cash flows, whereas also benefit from the increasing travel demand. But if anything goes wrong with these companies, the aircrafts are the assets that they use to back the creditors. So we can always sell the aircrafts and use that as the downside protection. So these are the themes that we're looking for in today's world in the fixed income market. And again, bonds were back and bonds are better right now. So we want to be diversified in your portfolio, and you want to build that defensiveness in your portfolio by investing across a globally diversified, broader fixed income portfolio. So I'll pause here and look forward to more of the questions in our panel discussion later on. Thank you.
Thank you, Jingjing, for your sharing. And next, it's our pleasure to welcome Mr. Dennis Fogg, Head of ETF at MiraeAsset, to share your perspective in Hong Kong and China market.
Hello everyone, very nice to see you this evening. My name is Dennis and I'm actually heading up the investment team in Global X ETF. For those who may not be aware with our franchise, Global X ETF is actually a leading ETF issuer focusing on cover call ETF and also thematic ETF solutions. The thing is that, before we talk about the slides, actually I saw some of the familiar face because sometimes I talk to different types of retail investor forum. For Cantonese speaker, I'm from Hong Kong. The thing is that, when I invest in pension fund in Hong Kong, one thing I noticed from the investing in Hong Kong and China underlying exposure is that there's only volatility, but there's no price appreciation. That's something that really disappointing. That's very different from, other two speakers talk about, US equity market, you see the long-term trend. However, This is not the case for Hong Kong China equity market. As an index portfolio manager, we always try to understand why. So this is something that, you know, I would like to share some of the ideas for you to maybe some of the takeaway that, you know, maybe at the end I will talk about, like, you know, oh, there's only one thing for certain is volatility would continue for Hong Kong and China market. So, okay, let's take a look at what's going on in Hong Kong China market. You know, everyone knows the trend. You know, the ROE, return on equity, has been dropping. The market is not performing. And then, you know, recent rally, actually people becoming a little bit more positive about the market, because the thing is that, you know, you can see the foreign, you know, analysts start to maybe revise upward about, you know, the ROE. That's something promising that, you know, finally something, some people, especially outside of this region, start to revise up, you know, the market. So that's why the momentum could be continuing. That's very interesting. And the corporate earning, you see, you know, is slowly going up. One thing that I would like to highlight here is that, you know, the index. Index is very, very important. As some of the, you know, the speakers previously talked about, if you look at the, you know, MSCI World Index now, 70% of the exposure is U.S. equity. It means that, you know, now we have 14 trillion of the AUM in ETF, asset, you know, in the world. If you buy ETF, broad-based market cap ETF, 70% of your money, if you buy the MSCI World, it would go to U.S. equity. That's why you see the, you know, the market cap rated indices, you see the Magnificent Seven is outperforming, that's for sure. Of course, until this year, you see eco-weighted has been outperforming, you know, in U.S. equity. However, this is different in China. I can tell you, you know, 10 years ago when I looked at the MSCI EM index, 50% of the exposure was Chinese equity. And you know, like last year, when I teach a university class, because I need to refresh my memory after 10 years, and then I find that, you know, in MSCI AXJ exposure, we find China was only 1% higher than MSCI India. I was very, very surprised. However, I checked the number today again. I saw it went back up to 34%, and then India still 21%. I would say, you know, it's very different picture. That's why, you know, the index actually affect a lot of Chinese, valuation. If the index weighting keep going down, you will see the global flow maybe, you know, slowing down. But the thing is that now the good news is that it go back up to 34%. Hopefully, when people start to look at the emerging market, especially the U.S. Treasury yield has been, a little bit lower, maybe potentially, at the end of this year, then, you know, people may start to think about emerging market exposure again. And then you see, I think one of a very little chart here I would like to, highlight is that, of course, the number is a little bit small, is that, as the previous speaker talked about, a lot of global fund managers outside of this region still underweight China quite systematically. So you see the global active fund manager, they are still only holding 6.6%. So basically, they underweight. However, you know, given the recent market rally, as I said about, this year, the Hang Seng Tech Index went up by 25%. Of course, Hang Seng Index went up by 15%. It's mostly tech-driven, but the thing is that a lot of underweighted exposure, they need to find a way to try to fix it. So this is something that, you know, we believe that, you know, the catch-up will still continue, potentially, for the first half of the year, and potentially leading on the second half of the year. And then you see here, of course, in China, it's the DeepSeek moment. Everyone knows that, you know, once DeepSeek was, published, people start to think about, you know, the valuation of the China. However, one good, interesting thing is that if you pay attention to the Chinese bond market, the Chinese renminbi onshore bond yield, 10-year yield, is only 1.8%. It's kind of a very low level. The thing is that you see a lot of companies, if you look at the Japanese story, it was very similar. You know, when you face such a low yield environment, there's a lot of quota issue. You cannot actually get the money out to invest overseas. Of course, people here keep talking about diversification, but think about in China, how you can diversify. That's something that very promising, that when domestic Chinese companies think about, you know, if there is opportunity in AI, okay, 1.8% the bond yield, it means that borrowing cost is very low. Boom, let's try to invest, you know, more in AI. You see the capital, expenditure has been increasing. And for sure, you know, when people see opportunities, when you are hungry for so many years, then you see the borrowing rate is very low. then you start to think about maybe it's time to spend more cash. And then, it's very interesting that, you see another thing is that if you look at the Hong Kong-China market, even for the last 10 years, even there was no price appreciation, but there's one thing that, you need to notice is that you still get some return. For example, for Hang Seng Index, for price appreciation, before this year, it was flat. However, why, for last 10 years, your whole Hang Seng Index basket, you still get 4% every year? It's because of dividend. So one good thing about China is that Chinese, policy has been more pro-dividend. It means that they want the companies to return the capital to shareholder. A lot of companies in Chinese basket, they are having more than 15% of the free cash flow. As I said before, they don't actually have too much investment opportunities. That's why they have more than enough money to return to investor. Think about, if you hold a high yield basket, I'm talking about high dividend yield basket, for last 10 years, for China, on average, you can get 6 to 7% of the, dividend return, even though, everyone knows that China may not engineer another 10% of the GDP growth. However, 5% of the GDP growth may be enough for the companies to sustain this dividend payment. So all I want to say is that high dividend basket in China, why, a lot of onshore investors are tracing it is because, first, low yield environment, you can only get 1.8%, where can you go? Second, another very interesting point is that, the valuation still very, very attractive, especially for high dividend basket. Okay, so maybe I will skip here. So, and then you see, one thing, people keep talking about tariff. Think about, the US tariff policy, people worry about tariff. But the thing is that, this time, seems to me that, or seems to a lot of analysts that, Chinese market has been much more well prepared. Because tariff for China is not a news. And when you read a lot of domestic news in China, the tariff impact it seems to me that it's much less noisy than DeepSeek, which is good. Because the thing is that it means that, people are more confident that Chinese economy can diversify against, tariff. And then as you can see here, the US output, the US export to US has already dropped 5.4%. It means that they, would diversify to other markets, which is promising. And then interestingly, if you see here, this one, if you see the peak to export to US was 21%, now it's only 14%. So that's something that, a lot of Chinese domestic companies, they are very thankful that, a few years ago, they already think about diversification. That's why, when I think about the topic today, diversification, I also think about you need to be looking more long term. After 5 years, what should you do? Okay, I want to show here, this chart is very interesting. I showed you a lot of Hong Kong retail investors. I talked to a lot of institutional investors. When I said, why I said about in China for last 10 years, only volatility, but no price appreciation is that because that's one way that, you can extract some of the income, which is the option premium. I would say, if you compare the Hang Seng Index or Hang Seng Tech or HSCI against the S&P 500 Index and also Nasdaq 100, you will be surprised to see so high the option premium for last 10 years. For HSCI, for China Enterprise Index, last 10 years, annualized option premium, if you write the call option every month, if you roll over for 12 times, on average for 10 years on annualized basis, 28%. And what's surprising is that, of course, if you write a call option on a very volatile basket, Hang Seng Tech, for last few years, it was over 40%, which was quite funny. What it means is that every month, you just forget about upside, about Chinese market. Just went out, just like your, apartment, just went out the upside. I don't really care. Then, on average, every month, if you write the Hang Seng Tech, every month, you get 4%. But of course, you need to cover your basket. Something that I would like to show is that, this is the monthly distribution of the monthly return on Hang Seng Index and HSCI Index. If you see, of course, no surprise, for last 10 years, you plot the monthly return, it will skew to the left because the market was not performing. Everyone understand. Usually, when market went down, volatility go up, option premium will also go up. this is what we are observing in the option premium in the market. But you know, 1/3 of the time, standing between minus 2.5 to 2.5. This is perfectly for cover call because you don't want the market to move too much. Because if you go down too much, then cover call position still, would lose money, but of course you lost less than the market cap rated. However, of course, it happened here for the last few months that the market really rallied a lot, but what's the opportunity? This is something that I would like to tell you. That's why after I look at all the scenario, of course, this one, of course, I hope it will happen in China, but the thing is that, one direction, increase, I haven't observed for so many years in China. But the thing is that the scenario I have been seeing is in the middle. Just like don't move in too much, just up and down 1%, or it goes down. So in both scenario, cover call can help, especially for this one, because the thing is that it can outperform. So I would like to just quickly highlight, that's why, I think about it, as a fund manager, we should try to, navigate what the market is doing, and then launch the world, the first cover call on the HSCI index. And then the reason why I show you here is that it's not to sell you product, it's to show that, I'm actually, this is the real option premium I'm writing. I'm a fund manager, I'm showing you what we are doing. And then you see every month, the minimum, was 1.5%. September, October, very, volatile moment. You went out 1 month of the upside, 4%, 3%. And then, regular income, of course, monthly distributed 1.5%. Last year alone, on annualized basis, we distributed 18% of the distribution yield. I don't believe that you can find a strategy which can distribute such a attractive option premium. However, of course, every single investment has a risk. As a fund manager, I always think that the major risk is that the market keep rallying one direction, keep outperforming, then you lose out. But the thing is that you lose out, it doesn't mean that you don't generate return. But the thing is that another bigger downside risk is that the market actually adjusts a lot, right? Down 50%. But the thing is that option premium may be able to help you a little bit, but remember to cover your call. Because the thing is that I heard so many people actually say that don't cover, don't worry, the market won't rally. But the thing is that, it happened for the last 2 months. Thank you very much. Yeah.
Thank you, Dennis, for the overview of the market. And finally, let's welcome Mr. Archie Parak, Group Head of Risk and Head of Investment at Syfe, to share his thoughts of investing in this uncertain time.
Hello, everyone. So yeah, I guess you have heard from our guest speakers, and I mean, one thing is clear, that the path ahead for this year is going to be uncertain. As Jingjing was saying, uncertain is certain for this year. So I'm here to help to see how we can plan ahead, how we can think about positioning our portfolios and not panicking in these times, so that we're better prepared. I think I'll start with a very simple philosophy, is like, as humans or as investors, what can we control and what we cannot control? I think a lot of us in general tend to focus on returns, which none of us can control. It's very much driven on multiple factors, which are nowhere things that we can control. But what we can control are risk, cost, our time spent to do the research, our behavior, and ultimately come up with an investment plan that fits and that we feel comfortable to ride. I'll come back to this and I'll go deeper into it, but I think just to start with that thought, the best way to navigate periods of volatility is to plan better. I think with that, like, I'll quickly run through some of the portfolios or products that we offer, and that'll help you to understand, and we'll come back to those things, like how can we construct certain things in a simple way which can navigate these markets. So very initially we shared, like, effectively how we want to think about our portfolios is, things on the left are low risk cash solutions, which effectively are a better way to park your idle cash. We have solutions in Hong Kong dollar, US dollar, The leftmost cash plus fixed is a fixed deposit investment service. The flexi one is a liquid money market service, ranging around 4.2%. Income is very similar, and we actually use BlackRock and PIMCO and few other asset managers. We create our own portfolios to basically add that diversification, look for that resilient income market to still generate enough, closer to 7 to 8%, but help to protect or conserve the downside. And on the right are the growth portfolios, some thematic, some longer term. Now, I think very interestingly, and this is effectively one of the best selling product that we have. Very simple but very interesting. So what we call is like cash plus fixed, which is effectively an investment service where we work with multiple banking partners to give you access to bank fixed deposit rates. So some of the banking partners that we work includes HSBC, for example. We get institutional rates because of the size of a firm across the region. We very simply pass on those rates to you. So you don't have to worry about hunting for which bank is offering what rate at what time, what are the conditions there, is there any minimum, is there any maximum. You don't have to read through XYZ terms of those things. Very simple, clean. We work with multiple banks, give you that solution in one single platform. You can access the best rate on the street. So and effectively, basically, where it like very clearly from a comparison perspective, you can see is these are the rates like a couple of weeks ago, but the rate that we are able to get as an institution versus the rate offered by the top banks in Hong Kong, there's a huge difference. And from our perspective, again, we simply pass on those rates to you guys. The next product is slightly different. It is again a cash solution, but this is more for people who want liquidity, who needs that cash to be available very near term. So the cash plus flexi, and this is a US dollar product, is built using what's called money market funds. They are daily liquid. You can take your money out tomorrow, but you can still enjoy attractive yields, which are 4.2% currently in US dollar. Again, very efficient solution instead of keeping money in the bank. With having access to liquidity, with having that access to money at any point in time. So now I think the third thing, which is fixed income, and which I think we believe is something which I think in Asia generally we don't own, all of us don't own a lot, but this is something like Syfe, and I think in general you'll hear from a lot of institutional investors that this is something we should own a lot more than we have done in the past. Historically, I think the interest rates across the world has been very low for a long period of time, but in the last couple of years, as Jingjing was sharing, the yields have gone to a meaningful level. So it's hard to ignore, and again, these assets like fixed income acts as a great cushion against market volatilities. So the product we have is built using active funds managed by fund houses like BlackRock and PIMCO. These portfolios generate up to 8.6% monthly income. We directly pay that to your bank account. You could choose to invest, you could choose to collect the coupons. What differentiates us is two things. I think the approach from an investment philosophy we take. We have a team of investment professionals across our group, as you have seen, working through large institutions in the past, and we think long term. We think strategically what makes sense, what doesn't make sense. Work with our partners to understand where institutional investors, where the money is flowing, and bring those solutions packaged in a simple way to everybody. Means the returns speaks for themselves. So these are again for two of the portfolios that we have outperformed the benchmark consistently for since we launched 1.5 years ago. Now, the most important thing, and this is going back to what we can control, the cost. So I think fixed income funds are not like something new. They're available on a lot of platforms, banks, brokers. But I think what a lot of people don't understand, don't see, is the fees embedded in there. Typically, when you go into platforms, what you can access is retail share class. So typically, a fund will have what's called a retail share class, which is for everybody like us, and then what's called an institutional share class, which is only reserved for institutions with a minimum size. And there is a big difference in general in the fees, and that difference can go even up to 1%. So that's one. And the second thing, obviously, is like a lot of platforms apply fees that to subscribe, to redeem, to switch between things. All these things adding up can be very significant. So on our platform, we actually can access institutional share classes of those funds, similar to what I was talking about, those fixed deposits. We leverage those relationships. We pass on those things directly to you guys. So that's really like, that's basically saving 1% a year can make a huge difference in the long run. From a growth portfolio perspective, I think we again work with a lot of ETF houses, including Mirai. The big thing again here is thinking long term. Our entire investment philosophy is about creating a portfolio which can generate decent returns over a longer period of time. Recently, and means we rebalance these things very frequently. In our last rebalance, we actually anticipated some of the things. We switched to what Thomas was talking about, some equal weight ETFs. We added gold in some of our portfolios, and those things have helped our portfolios to sustain the drawdowns, limit the drawdowns compared to other equity markets. Again, I mean, it's cost effective, expertly managed. What you need to do is just invest and let us manage. Again, like performances consistently over last 5 years, 10 years, 15 years, we have beaten the benchmark on a per annum basis. Again, shows the strength of our investment philosophy, the partners that we work with, how we can leverage, and again, bring those things, institutional investment philosophies to everyone. Now, I think going back to, cash income growth portfolios, how ultimately are those meaningful in the times to come? So I think for me, again, it's best to look at going back to the first slide I was saying, what can we control? Let's see, and let's go deeper into each of these things. The first thing, behavior, which my wife would say probably should be on the right, is something I cannot control, but I would want to put it there from an investment perspective, and you'll see why. So I think as a typical investor, as a human being, like when markets are rallying, we tend to get into that, there is no end to it, and we continue to go and buy. When things go south, we panic and we try to sell. Very simple human psyche. But I think the reality is market corrections are very, very common. Like S&P, or this is for an S&P index, like every 2 years, there are corrections of more than 10%. On average, corrections of more than 5% are pretty much every year. But what's most important is for us to stay invested and not panic. And I think this is the behavioral part of it. And very simple maths can show us, like, and this is what history tells us, if we try to time things, if we try to act in behavioral ways, and you miss even just the 10 best days of a year, your returns can significantly and fall by more than half, 50%. If you miss the best 20 days of the year, it can fall by 73%. So the importance is, and to add, like, actually the 50% of the time, the best days happen in a bear market. So this is the behavioral part in finance, where staying investing is very, very important. Now, I think now the next part, which is risk and cost. So we understand staying invested is important, but then are we ready to take the risk? Are we ready to take what is good for us? Because everybody can have a different risk appetite. I would be able to take a drawdown of 10%, 15%. For some, even 5% is big enough. So I think going back in very quickly, like again, like uncertainty is certain. U.S. economy is expected to slow down. The GDP numbers have been revised by everyone down. Where we are heading, we personally feel recession might not be there, but what we call stagflation, where unemployment increases, GDP goes down, demand slows down, inflation is sticky, is likely to be there. What it means, again, is, and this is very interesting from a perspective that how does different asset class behave in different market cycles. So you can see very clearly that there is no one market cycle where everything is green. So this goes back to the point of how can you manage your risk. One way is diversification, and depending on which cycle, you don't have to worry about. If you are able to diversify your portfolios better, you can weather those storms in a smoother way. And again, we can see through things this year, like Magnificent Seven, and again, Tesla not there, but have been significantly down. Again, if you were concentrated versus S&P, still down. Our equity portfolios were almost flat, again, to the benefits of some of the stuff that we have done in last couple of months. And income, which I was talking about earlier, is actually up. So this is really one way to think about the behavior part. Then the second is risk, which is diversification. Now, another interesting fact, and which, again, like when we think about active versus passive, there have been a lot of studies around this. Very interestingly, more than 90% of the returns come from pure asset allocation. Market timing or security selection contributes to less than 10%, or even single digits like 6%. So, most importantly, how do we plan? How do we think about what risk can we take? Ultimately, that drives what asset allocation, and then that will effectively drive 90% of your returns. And this is the simplistic way how I want to summarize in a way that, like, how to think about, again, what risk I can take, and then how should I think about then what assets I invest into. So this is like returns versus risk graph, very simple. On the right, high returns, on the up, so on the right, high risk, on the up, high returns. If you are someone who can stomach 30% drawdowns, going for 100% equities in the long run is the best way. Equities, I think, had historically been the best asset class, but obviously the risk is high. If you are not that kind of a person, if you can not stomach even 2% losses, go to the extreme bottom left, which is in income or cash portfolios. I think I'll just finish by kind of sharing a very simple example which effectively helps you to think of how to allocate again. Like so if you're something who are somewhere in the middle, like can take 10 to 15% of volatility, growth is a great way. What it means is allocate about 60 to 70% in equities. The rest can go into fixed income or, depending on the liquidity, in cash solutions. If you have risk appetite is lower, reduce your equity allocation, increase your cash and income allocations. And again, in the long run, this is the best way to manage and navigate the uncertainties, the times where the drawdowns could be high. You can sit back and to the first slide that Kevin showed, enjoy the swimming pool and let basically the diversification and the planning help you navigate these times. So I think that's it from our side. We'll probably take a short break and come back for Q&A. Yeah, sorry. So before we head out for food, We have an exclusive event offer. If you sign up and deposit, you can earn up to $1,500. And in addition, I think there's a referral program as well. If you refer a friend, each of you can earn $1,000. Enjoy the break.
Because they get their fees. I remember you. Like what they do is like they keeping money to like as an and those guys are actually so what you would do is like sure. Here we go, like 10,000. It's on the line, so they don't have to use like fans or so a lot of people are like more too much.
燒埋咯，佢哋腳停一停先。
Sorry to interrupt.
Welcome back, everyone. It's time to dive into our panel discussion. Please join me in welcoming our guests of honor, Kevin Lee, Archie, Jing, and Dennis Foy.
First of all, thanks everyone here. So stay here so late here to listen to our panel discussion right here. And also welcome all of you back to the stage. I think all of you have learned a lot today from our investment leader today. And I think many questions have been dropped in the Slido, and I have also gone through all of the questions. Most are very interesting. And I think the first question today, the winner, is China Hong Kong related, which is I think many people, local investors will be have the same thought: is China right now long-term bull market beginning, or it is just a short to mid-term upside? It would be a question from many people's mindset right now because Hong Kong China has been disappointing many investors for a certain period of time, right? So this may be the questions to Dennis. If you don't mind, you can share some of the thoughts on that, and also some capital flow between China and Hong Kong. What will be the difference after current market upside?
Sure. Thanks for the question. I think first, there's no crystal ball. I think that's the common answer. But the thing is that, as an index portfolio manager, as I said, I always take a look at index. There has been a lot of active fund manager trying to bid in Hong Kong China market for the last few years. But everyone knows that, Hong Kong China market, the style rotation has been very quick. If you see, a lot of different sectors, a lot of different themes. For example, like last September, October, why you sell call option premium every month can have 4 to 5% is because a lot of people, they don't quite believe this rally can be sustainable. And the option market was quite true, right, last September and October. But one thing I would find is that as an operator on call option every single month, call option premium has been slowly going down a little bit. So this is a good, I would say, this indicates that, if you look at the option market, I think the volatility has been, gradually dropping. And one interesting thing I observed is that if you look at the MSCI China composition, a lot of weighting, I think over 75% is concentrated in Hong Kong stock, and of course those are technology names. And if you look at the China A share this year is still quite flat. There was one chart in my presentation I didn't talk about is the AH premium. That indicator has been shrinking. That's a very interesting thing, that where the China A share would catch up. But the thing is that, if you look at the flow from southbound, so I would say, in Hong Kong China market, I think people have to look at southbound because our onshore mainland Chinese investors, they are actually a major source of, flow. Is quite strong. And then if you look at the onshore China market, it seems to a lot of investors that, onshore mainland retail investor, they believe in technology story. They do the treasure hunting in Hong Kong market, but they kind of ignore China Asia. So this is something that we see.
Okay, thanks. Dennis answer. Any other want to add on the China market? Okay.
I think probably I think from Syfe's perspective, we are cautiously bullish. I think the weight in our equity portfolios on China. I think Dennis was showing that in general, probably portfolio managers are allocated about 5 to 6%. We are closer to 10%, and that's the call we took end of last year. That has worked well, and we still believe, I think, in current dynamics, China has more leg to go.
Okay. So yeah, I think to summarize, I think still many of our investment managers here are also view about China market can be good. There will be some more upside here, and we can be more optimistic compared to what we have seen before. So the next question we want to ask also on Syfe background, because we know from Kevin, he has already introduced some of the about Syfe backgrounds and all other areas about Syfe. But I think some of the people here in their mind also from the questions I have read about is what's the difference actually between Syfe and other digital brokers or virtual banks in Hong Kong, and the positionings or the product suite, whatever. Maybe Kevin can share more on this.
So indeed, before joining Syfe, I mentioned I head up the digital business for Schroders Investment, one of the other largest fund houses in the region or globally. And actually before that, I worked in McKinsey, Accenture, and such. Right? I worked in a lot of industries, and especially with the banks and insurance. Maybe I'll answer this question in two parts. One part is what are incumbents? What can the banks and the others brokers offer and Syfe can offer, and then the difference, right? So professional investment service, yes, we do offer that, right? Our background, you can see, a lot of institutional background, right? The investment return track record, we also offer that. The assets and partnership with some of these largest asset managers or ETF providers, yes, checkbox, right? And how are we different, right? I think one is basically the lower cost structure that we have shaped. And to build that, we need to have a very efficient digital platform and model, right? How do we run our business as efficient as possible so that we can give back, that cost and margin to everyone, right? So that's something very important, right? As Archie mentioned, we are rebating, some of the, 100% of the fee that we are getting, and we are independent when we select the different product. To be honest, right? Months ago, our income product, right, the passive income product, we are not, selecting, BlackRock or PIMCO at that time, right? So we move with the market. We pick different partners at different time, right? And now we know, hey, it's the time to rebalance, and we rebalance. So we provide that capability. Second is we want to offer the investment service, professional investment service, institutional service to everyone. It's a big vision. It's very difficult, right? So it has to be no minimum. It has to be, easy for everyone, right? But of course, in Hong Kong, a digital-led company, to activate an account, you need to put 10K Hong Kong dollar to activate your account, and after that, no minimum, right? We are even working on that, right? So stay in touch with us. We'll truly make it no minimum, right, soon, and so that you can try and understand how we offer the services, right? And then lastly, I think is the innovation, right? Give you an example, I think Archie already covered, is time deposit. Everyone loves time deposit. You look at the few trillion retail funds in the bank, right? A lot of them are in time deposit. But nowadays, you look at the news, the leading bank offering 13%, 14%, 10%, 8% for 7 days. It's a lot of promo driven, and go through all the terms and conditions. Only player like us, right, somewhere between banks and broker, investment platform independent, we can create an innovative product. First in Hong Kong, no one has ever done that. We talk to the regulator, like, oh wow, this structure is very interesting. Like we offer investment service of multiple banks time deposit, and we'll give you something without maximum minimum, right? We're launching actually a few other products in the coming months. I mean, innovation is at the core. The partnership is at the core. So these are some of the differences. But still, some clients, I handle some client calls still. I want to understand how our clients are interacting with us, right? And then one call, the client said, "Hey, Kevin, you know what? Like, it's very hard to trust you guys." I said, "Oh, wow, but you have put $1 million in already." Like, yeah, I'm the minority. I tell how great you guys are. I try to share with your friends and everyone, right? They were like, no. Yeah, I'm used to putting in the bank. It's fine for getting lower rate or return or whatsoever, right? I think the stickiness. I'm not saying the banks are bad. We work with them. They are our partners. They are our partners, right? I'm saying that. The open-mindedness is very important for Hong Kong people to embrace innovation, right? Then we'll have more innovation. There's something very important that we're also driving, right? We are not just a tech company. We're not just an investment company. We're coming to indeed bring a new way of investment philosophy, a new way of embracing fintech. So actually, apart from being the head of Hong Kong Syfe, I'm the co-chair of Wealth Tech Committee in the FinTech Association of Hong Kong. So I connect with Shenzhen and some of the largest associations to kind of promote this, right? How to embrace innovation. The lastly, right, I want to kind of cover is we do have our office that you can come and visit us. Though we're digital first, we're people answering call. You can come to Central, right, as China building. You can book an appointment. Our advisor will also talk to you. Thanks.
Yeah, so I think everyone has also know about some of the key points that Syfe has provided to the market. Innovation, providing good investment product at a low cost, and also we don't ignore the point of human touch, the importance of human touch to all of the clients, including all of the retail investor and also private clients. So we have different kinds of, Syfe has different kinds of products, including some cash and income product that I think Ashley has already covered in the sections just presented. So I think another question that many audience has also asked on is about the income and how the fixed income environment. Right now, actually, what types of fixed income would be better for a normal investor to invest, and also what types of fixed income will be more cautious and not to invest for normal investor. I think this question maybe Jing will be the best one to answer.
Sure, thank you for the question. I think I shared a bit about what sectors or segments that we want to focus on during my presentation. Overall, we think that in this market environment, the strategy that would work well is something that focuses on stable income generation and also something that's more diversified. So if you already have a lot of equity, think about fixed income. If you already have a lot of the US market, think about global, Europe, emerging market, or even Asia. Diversifying your assets will be very helpful, and also with the focus of defensiveness. So the sectors that we like or don't like is also around the same theme. So for example, the more defensive sectors we're more focused on, like the aerospace defense, and then within energy we like pipelines. And these are the sectors that will give you very clear cash flow visibility. And you can also predict how much of the cash flow you're getting from the companies. And you would also know that even if the market environment changes, these are relatively counter-cyclical. So they're not going to be as volatile as the more cyclical sectors. So those are the cyclical sectors are the ones that we wanted to avoid, and also the ones with more secular headwinds. So for example, in the credit space, we're more cautious on the upstream or downstream energy because they tend to move together with the commodity prices. We are also cautious on the sectors that facing secular headwinds, for example, the retail sectors. And then the ones that's going to be more heavily impacted by tariffs policies, for example, the automobile sectors. So these are the bottom-up ideas that we wanted to build from the portfolios to protect people from downside risks, whereas focus more on the higher quality, more defensive sectors. And overall, fixed income is a asset class that can give you this level of defensiveness in the market environment, and especially when a recession risk is higher. In a recessionary scenario, the Fed will cut more rates, and that's the additional capital appreciation you're getting from the bonds market.
Thanks. I think overall, I think fixed income market is still a good investment in this rate cut environment, and we have heard about also some different kinds of fixed income, which one better to invest on, which one is not the best one to invest into. I think from Syfe also we can see some of different flows into cash and income. And for Q1, I think most of the audience here also want to know the recent inflow for Syfe in Q1 in 2025 and what products are clients focusing on. And hope this question actually can give us some insight on that, and then we can also know what is the flow from retail investor.
Yeah, sure. I think on our side, I would say in last 3 to 4 months, most of the flows have gone into cash or income portfolios. I think which is very natural, which is like when markets are turbulent, the natural thing is flight to safety. People start moving from riskier assets to safer assets. This is something what we have seen on our platforms as well. Cash and income have been the biggest beneficiary of those things. And from our perspective as well, like I was sharing, I think in general, a lot of clients are under allocated in fixed income from what we see. So this is an education that we have also been doing with our clients whenever we speak to them, and slowly we seeing them appreciating and start moving assets away and diversifying overall. And I think one thing which a lot of people don't easily see is like fixed income, actually the yield acts as a huge cushion. So even if like we don't know how many rate cuts, we don't know when the rate cuts will happen, but the starting yield that we are getting in current markets without taking too much risk is like 6 to 8%. Even if you control the risk, the duration of the portfolios, you have a 6 to 8% cushion, even if the interest rates remain here or markets going to start pricing in higher inflation. So that cushion helps to protect your portfolio. And this is again what we saw like year to date again, just in last couple of months, like fixed income market has been up to 2 to 3%. Clearly shows, and it's a great hedge, as Jinjing was saying, like if the recession risk starts to be priced in higher, which we don't think is the base case, but if it happens, actually the fixed income market will be the biggest beneficiary, because the expectation of Fed to cut rates faster will increase, which will help the bond prices to go higher and have a positive impact on the overall portfolio. So yeah, so I think, this is something which we have been advocating to clients recently quite a lot, and we see that's where the biggest flows have started to come in the last few months.
Yeah, we also see the flow of income portfolio, which are actually going up quite fast in the recent first quarter, and also the last year actually.
Yeah, so and actually, just to add, like I think even if you look at the Hong Kong market, fixed income funds and like Hong Kong Investment Fund Association, separate body, publishes results every month across, I think, various asset class. Actually, in last 2 quarters, fixed income has been the biggest beneficiary, or where the inflows have started to come in, even across broader mutual fund space in Hong Kong.
Thanks, Archit. On all the fixed income flow overall from the Hong Kong market and also from Syfe inflow. I think another big question many of us also want us to answer is about a cover call strategy that Dennis has been mentioning, which is very new actually in Hong Kong, and I think it's the first one launching a cover call ETF in Hong Kong market. And the question is, what are the views on cover call ETF and the associated risk? And is it a good time to invest in such a product in this uncertain market? So yes, Chris, Dennis.
Sure. That's a great question. What's my view on cover call? My view is that volatility would remain in Hong Kong China market. That's for sure. The thing is that when we think about why we are thinking about cover call in Hong Kong China equity market is that from the performance perspective and from the nature of the market and from all the like southbound mainland Chinese flow, from their investment philosophy, you really see there's only a few markets in the world who's more suitable than Hong Kong market. Of course, people talk about US cover call, but the thing is that US cover call, the problem is that US for the last 10 years, it has been one directional increase. What it means is that, yes, I may be able to distribute, 12% of the premium for you, but the thing is that, if you invest in bond market, you are able to earn more than 20% per year. That's for some of the investors, they are looking for total return, absolute return. That's something that, you may feel you are missing out on the value. But the thing is that for Hong Kong China market, if you think about, it's very difficult to find defensive strategy when market is volatile. You talk about dividend. For example, for dividend strategy, the problem is that valuation still very cheap. However, yes, it's cheap for a reason, right? So that's something that people are concerned about. But in terms of how to extract the regular income from the volatility, I think there's not many choices. And then when we took a look at the option, so that's something very interesting. One more thing I would like to share is that from what we are seeing in the retail world in cover call, we launched 3 cover call: Hang Seng Index, HSCI, Hang Seng Tech. At first, I was thinking about people look for stability because Hang Seng Index is more stable than other two. But at the end, I find people are look for premium. The HSCI actually sold very well. I think we see $130 million inflow very quickly within 1 year. So that's something that I would say that, for example, I just talked to some of investors I have been seeing for the last few times in the seminar. This has shown that, the retail investor in Hong Kong, they actually understand options much more than I thought. So this is a very promising, scenario.
Actually, I want to ask in the audience, like, how many of you are aware of what is a covered call or what is a covered call ETF? If you can show hands. Okay, interesting.
It means that I need to do more education.
No, and actually, like, I think just to add one thing is this is something which, yes, has been very popular in the US, kind of a income generating strategy. And I think, SMEDE has always been in front of innovation in these things, so it's a great products that are launched. At Syfe as well, what Kevin was mentioning, we are launching few products in the coming months. This is something which we are working on as well. So if you guys are interested in this strategy, we can chat offline on it.
Yeah, so I think one of the key points that Dennis has also mentioned is, people in Hong Kong somehow not only looking for safety product, but also they will look for some high yield product, which cover call may be some strategy that people may like. Syfe also can, maybe we can also consider on all this strategy as a whole. I think right now we also open up to the floor for the questions. If any one of you have some questions that our expert here hasn't been answered, or you have some question you still want to ask right now to any of us on the stage, you can feel free to raise your hand right now, and then you can just ask your question directly.
Hello. Thank you very much for putting on the event this evening. My question is around digital assets. Jingjing, you also mentioned DJT as a big person of market volatility and uncertainties. Specifically, I'm looking at asset allocation, Bitcoin, and digital assets, and I'm curious to see how you and your colleagues view Bitcoin as a way to hedge some of these uncertainties as part of a portfolio of equities and fixed income. Thank you.
Okay, thank you. That's a great question, but I'm not sure if I'm in the best position to answer because at PIMCO we actually don't include digital assets or Bitcoins in our investment universe. So I will see if any of the panelists have any more insights. I would love to know as well.
Okay, I think it's interesting that people bring up digital asset. Of course, we don't have offering in Hong Kong, but the thing is that what we are maybe just one quick view is that volatility is there, is high. That's why always people think about of course as a long-term strategic asset, is it something that you can hold for long run? I know there has been a lot of talk, and then we see in ETF world, like a lot of other ETF issuer, even including the traditional ETF issuer, they are launching crypto asset ETF. But what I would say, in this industry, we are talking about is that, for the if you look at the crypto ETF, most of them just buy one or two, basically one, or if you imagine, if you buy stock, right, you just have one or two stock in your portfolio, you don't feel diversified enough. So there's a lot of talking about creating index, and of course some indices have been created, how to replicate those index. But from the portfolio manager perspective, I think there's still a lot of things that we need to think about. If we replicate, are we using physical, or are we using futures? So that's a lot of work on it. But of course, from the standing point, I think now the crypto asset ETF has been entering phase 2. It means that not just single asset, but hopefully we can have multiple wrapped into one ETF.
Yeah, any question? Yeah.
Hi, I want to ask Jingjing for the PIMCO for the income fund for PIMCO because I was aware that the first one is that the inflation may be increasingly important due to the tariff. So how do your funds or portfolio hedge against this risk so that it won't cause a drop in the bond price? The second one is that I heard that the Fed has stated that they will hold treasuries instead of MBS in the futures for strategical reasons. So how would you hedge against this issue so that the positions of MBS in your fund will not be infected by this, say afterwards the easing cycle, they may not purchase more MBS anymore. So how would you hedge this risk?
Yeah, sure. Thanks for your question. Let me start with the first one, which is how do we protect ourselves against the inflation risk? If you notice, when I was doing my 10 minutes presentation, I actually skipped one slide, which is actually talking about the inflation protection bonds, the TIPS. That's the way how we put in our portfolio and hedge against the inflation risk. We actually right now have more TIPS position than if you look at the portfolio a few years back. So we do dynamically monitor the inflation expectation and the basis that's priced in, and we use the TIPS to protect ourselves. And then from the sector selections, we also pick the sectors that's more resilient, or that can, or the companies that can protect their margins against inflation. What does that mean is the companies that has stronger pricing power, they can pass through the inflation risk to either their suppliers or their consumers. So these are the themes that we build in our portfolio. And the second question for MBS. So the reason you just mentioned is exactly why we're seeing a wide spread in the MBS market in general. And that's another slide I actually skipped in my presentation as well. So if you look at the valuation, historically, it's very rare to see the credit spread, to see the spread of the MBS market to go beyond the 2 standard deviation. Whereas right now, they are at that range. So that is also why we think that most of that is driven by technicals. So it's not just the Fed, but also the regional banks, the smaller banks, they have to reduce their holdings, and that's what caused this whole volatility, and that's where we see opportunities for investors, especially active investors like us, to take the opportunity. And we're comfortable with the risk we're taking in this market because it's basically very low risk. It's more of the pricing volatility that you probably have to bear. But we also see it as a good way to diversify the rates exposure that you have in the portfolio, and also an effective way to improve the yield for the portfolio. So I hope that answers your question.
So, any more questions? Okay. Sorry, Morton. So I also want to address kind of the 2 questions briefly from a side perspective, right? The gentleman over there asking about digital assets, and then another gentleman asking about fixed income and how to hedge some of the REITs. So in terms of digital assets, right? Syfe takes different approaches, right? We kind of offer cash managed solution and managed portfolio. So it's like a managed approach, right? We also have brokerage. And nowadays when people invest in crypto, a lot of them, they directly invest in crypto. So they choose to believe in this kind of people see that some people investing in that, they see it as an asset class. Some fund houses, they don't see it as an asset class, right? I also work in insurance before. And in the managed approach, right? Some would actually create, let's say, crypto ETFs or active funds with normally, some allocation to crypto, but may not make a big difference. Some would completely not reckon it as asset class. But in mainstream, a lot of investors are still, picking their own battle, taking their own risks, and investing in crypto themselves. So in Australia, we launched brokerage first, and then we actually allow the investor to trade the top 10 crypto in the market. So we provide assets, right? So in this space, the question is whether Syfe would also think about providing advice or managed solution on crypto. That's something we're always looking into and exploring different opportunities in the market. So once you become our client, talk to us, share us your view, right? When we see enough demand in the market, right, we'll come take some move into that as well and look into that. And one thing very important is when we talk about digital assets, we always think about crypto. But there is also blockchain, right? It's the technology that's empowering all these digital assets. And digital assets could, leveraging blockchain, we can actually offer like tokenization of real assets or different alternative investments. Like in Singapore or now in Hong Kong, there are some potential partners or some firms, they offer, for example, tokenized whiskeys. How many of you invest in Japanese whiskeys, right? I think you got some, earning there, but you can't store a lot of whiskeys. And would you offer this kind of exotic services? You will only be professional investor for now. So regulatory landscape also play an important role into considering whether we make digital asset-led, managed portfolio for the investors, right? So there are a lot of interesting areas around that. But now inside we also have a disruptive tech thematic portfolio with exposure to blockchain and related assets, right? They are more solid, right? You can see the economic value that's generating, more stable, right? You can pick some of these things into a portfolio. I think along with the other kind of question, right? The approach we take is even in fixed income, we don't only create a portfolio with investment or exposure in one fund. We kind of overlay another layer of diversification, and create portfolio of multiple, best-in-class fixed income fund in Hong Kong. And we have specific objective of giving you target payout that is automated, to pay out into a bank account. So it's like a different approach. So same case, if there's a day we'll introduce a digital asset, either we'll put in brokerage, then you make your own choice, or we'll kind of use a similar approach to create a diversified version of that so that you don't take too much of a downside risk, but kind of get a little bit of that upside. Yeah.
Yeah, this, I think, check this here.
Sorry, I want to ask about the opinion on perpetual bonds. Should we avoid them by all means after the collapse of Credit Suisse?
If I understand correctly, the perpetual bonds are the bonds with no maturities, right? So think about the risk you're taking there is actually more like equities. The beta of the bonds are more equity related. So when you allocate, I think you need to compare the valuation and also the risk you're taking. So if you think the companies you're investing is giving you similar risk, similar fundamentals compared to a equities market, but if the yield is not as attractive as the stocks that's providing, so probably might as well just buy the equities. And if you compare the yield with a comparable IG bonds or even high yield bond, and if you think that the yield pickup you're getting from the perpetuals are more significant or that can justify the risk you're taking, then why not? So it's basically a balance between the risk and the reward. So just find the benchmark and do the relative value analysis and do that case by case, I would say.
Actually, just on the Credit Suisse part, I think the biggest thing which was probably with that Credit Suisse and UBS merger was what's in Europe called AT1s or like convertible bonds, and those were in the old days when Credit Suisse issued them were structured not in the favor of end clients, and when UBS took over Credit Suisse, those were kind of just valued subordinate or junior to a lot of other bonds, while in reality they shouldn't have been. But we don't have a view on those things on AT1s per se, but I think the yields in general that they offer, but then the associated complexity, we feel in current times actually there are a lot of even investment grade bonds that can offer similar yields.
Yeah, we can still accept one more question. Yeah, please.
Hi guys. The big buzz so far has been April the 2nd, which is next week. Well, I want to get your sense, your feelings. Between April the 2nd and building into Q1 earnings season, are you risk off? Are you risk on? Are you bullish? Are you bearish? What do you think?
Okay, I can start. I think April 2nd, what's called being called Liberalization Day. From our perspective, I think things will be volatile, and it's very hard to see whether the tariffs are a negotiation tactics or how real or how serious those things will be. So I think next 3 to 6 months, in our view, things are going to be up and down, left and right. So from our perspective, yes, I think like we have been saying, diversification is really, really the key. So focus from that perspective, again, in our view, fixed income cash solutions add that diversification to the asset class. So yeah, so that's the view from our side.
I'll just say that we are cautious.
Yeah, I think when you talk about Hong Kong China equity, I think, of course, people talk about technology stocks and it's quite volatile. But I just talk about China Asia. A lot more institutional investors think about China Asia because it's kind of non-correlated to outside of the world. And of course, when we talk about early April here, for domestic Chinese investor, maybe they don't pay too much attention. So that's why I think that, in terms of the, attractiveness, I think Hong Kong China market, especially in today's uncertain world, because the thing is that for last 10 years, the world was certain outside of China. But now I think China, is certain because we know that the yield is going to stay low for a while. And then we know that the valuation is attractive. But the thing is that one thing I would do believe that, the uncertainty about, the renminbi currency, which is something that, people still pay a little bit of attention, but not as much attention as last year.
I guess I would just say one thing, right? Echo to the theme of today is stay invested according to your risk appetite, right? I think if you're thinking, you can take, you're thinking whether you're taking enough risks or not, enough risks, you can find us, book a consultation for free, and then we can go back and discuss for a personalized session, and we think about, okay, maybe you can take more risks, right? And then how do we create a diversified portfolio for you? What are the options on enhancing what you're doing, right? If you haven't made up your mind, that's one of the biggest mistakes that Hong Kong people are making right now, or a lot of region, and even some of my friends, right, is I haven't made up my mind. I'm thinking about April, I'm thinking about this and that. I'm listening to different experts sharing their views, right? And then, where are your monies? Oh yeah, in the bank accounts. How much you're getting? 2% or 3%? No, I forgot, I don't know. Maybe I put in a mortgage link but actually you can get 4%, right? If you're not sure what to do, I think the very first step is make sure you stay invested, right? At least your cash is generating cash for you. And for those that understand Cantonese, Syfe, we have a new slogan here in Hong Kong, very localized. It's called 用閒錢揾錢, right? 咁你就得閒啲啦, right? It's we work so hard for our life, and there's no crystal ball to seeing what will happen in the future. Nowadays, anything can happen, seems that. But stay invested, stay diversified, and take action, right? Really take action. Don't leave some idle cash in the bank. I like to leave some personal touch at the end. One of my close family members, I've been very busy with a professional career as a teacher. And for over years and years, not investing, right? Losing a lot of opportunities. And now she's a client of Syfe, and at least when she's still thinking and doing the study, the money is being invested. Remember what Archie shared? Missing the 10 days of the good days, 20 days, how that will impact your long-term return. That's what I wanted to leave at the end. Thank you.
Yeah, so putting all your idle cash at Syfe to optimize your cash return so that you can free up your idle time to handle more important matters in your life. So thank you for all of us, your questions, and also thank you for all of the investment experts here today. I think we can still drink and take some foods there. And then any questions, please come to the stage. And
we have the venue. Also, thanks for staying.
Yeah, we can also answer in personal for all of the questions that you have. Thank you.
Thank you. Nice to meet you.
What else would you do?